Gas and diesel prices in the United States have been climbing, and analysts are pointing to something deeper than just the headlines from the Iran conflict and the Strait of Hormuz. Here's the uncomfortable truth. Even if the shooting stops tomorrow, prices at the pump won't necessarily follow. That asymmetry, prices racing up and crawling back down, isn't an accident. It's a feature of how energy markets actually work, and once you understand the mechanism, you'll never look at a fuel price spike the same way again. The conflict involving Iran has sent a jolt through global energy markets, and American consumers are feeling it at the gas station and the diesel pump. Analysts studying the situation have landed on a striking conclusion. There's a new asymmetry at work. The Strait of Hormuz, one of the most critical choke points for oil moving around the world, sits at the center of the tension. And the core finding is this: fuel prices won't fall quickly even if the military activity around that waterway stops. That's the news peg. But the deeper story, the one that will still matter long after this particular conflict fades from the headlines, is the mechanism behind that asymmetry. Why do energy prices spike fast and recover slowly? Who benefits? Who suffers? And what does it mean for an economy like the United States that runs, in very large part, on diesel and gasoline? That's what this video is about. To understand the asymmetry, you first need to understand what makes oil special among commodities. Oil isn't like wheat or copper. It's the foundational input for transportation, manufacturing, agriculture, heating. Almost every sector of a modern economy touches it at some point. That means when oil prices move, the effects ripple outward in ways that are both fast and uneven. The fast part is the upside. When a supply disruption looks credible, a war, a blockade, a major pipeline going offline, traders don't wait for the barrels to actually disappear. They reprice immediately. Futures markets allow participants to lock in the price of oil weeks or months in advance. And when fear enters the room, bids go up instantly. The physical market follows. Refiners start paying more for crude. Trucking companies see their diesel costs jump. And within days, the consumer at the pump is paying more, even though not a single tanker has actually been stopped. Now here's where the asymmetry kicks in. The downside, the recovery, doesn't work the same way at all. Prices that rose on fear don't fall on relief at the same speed, and there are several interlocking reasons for that. Once you see them laid out, the pattern becomes almost predictable. Let's walk through the mechanism layer by layer. The first layer is what economists call menu costs and pricing inertia, but you can think of it more simply as the reluctance to reprice downward. When a gas station raises its prices, it's responding to the wholesale cost it just paid. When wholesale costs fall, the station still has inventory it bought at the higher price. It won't lower its retail price until that expensive inventory is sold through. This is sometimes called the rockets and feathers effect. Prices shoot up like a rocket and drift down like a feather. It's been documented across energy markets in country after country, decade after decade. The second layer is the supply chain. When a disruption hits, companies along the supply chain, shippers, refiners, distributors, start making decisions that take time to unwind. War risk insurance premiums on tankers rise when conflict threatens a key waterway. Those premiums don't drop the moment a ceasefire is announced. Insurers wait for evidence that the risk is genuinely gone. Shipping companies may have already rerouted vessels around the troubled region, adding days or weeks to journey times and burning more fuel in the process. Those logistics changes aren't reversed overnight. The third layer is refinery behavior. Refineries are complex industrial facilities. They don't simply turn up or down like a dial. When crude supply looks uncertain, refiners may reduce run rates, the speed at which they process crude, to manage inventory risk. Getting those run rates back up takes time, and in the interim, the supply of refined products like gasoline and diesel remains tight even as crude prices begin to ease. The fourth layer, and perhaps the most underappreciated, is the psychological pricing dynamic among producers. When prices spike, producers, whether they're national oil companies or private drillers, face a choice. They can increase output to capture higher margins, or they can hold back and enjoy the elevated price. In many cases, coordinated producers have a structural incentive to let prices stay high for as long as the market tolerates it. The Organization of Major Oil Exporting Nations exists precisely to manage this dynamic. And even without explicit coordination, the expectation that others will hold back can be self-fulfilling. Put all four layers together, and you get a market that is structurally biased toward sticky prices on the way down. The spike is fast because it's driven by fear and futures. The recovery is slow because it's driven by physical inventory, logistics, insurance, refinery throughput, and producer incentives, none of which move at the speed of a news headline. Now let's talk about who feels this and how. For an economy like the United States, the impact of an oil price spike that lingers is qualitatively different from one that resolves quickly. Gasoline is the most visible price in the American consumer's life. It's posted on signs at every street corner. When it goes up and stays up, it functions as a tax on consumption. Households with lower incomes spend a higher share of their budget on fuel, so they feel the squeeze disproportionately. Spending that would have gone to restaurants, retail, or services gets redirected to the gas tank. The effect on diesel is arguably even more significant for the broader economy, even though it gets less attention in the news. Diesel powers freight, trucks, trains, ships. When diesel prices rise and stay elevated, the cost of moving goods goes up. That cost gets passed through the supply chain and eventually lands on the price tag of almost everything. Groceries, appliances, construction materials. Diesel is embedded in the cost of all of them. This is sometimes called a cost-push inflation dynamic. It's different from demand-pull inflation, where prices rise because people have more money to spend. Cost-push inflation is harder to fix with interest rate policy because raising rates won't produce more oil or lower shipping costs. It's a supply problem wearing the clothes of an inflation problem. For businesses, prolonged elevated fuel costs compress margins in sectors that can't easily pass the costs on: agriculture, small logistics operators, regional airlines. Companies that locked in fuel hedges before the spike are insulated for a while, but hedges expire, and when they do, the higher cost hits the income statement all at once. Internationally, the same dynamics play out but with an added currency dimension. Oil is priced in dollars on global markets. Countries with weaker currencies pay a double penalty when oil prices rise. They pay more dollars worth of oil, and their currency may weaken further under the inflationary pressure, making the dollar cost even harder to bear. So how do we classify what's happening when a geopolitical event sends fuel prices higher and keeps them there? It's not simply a supply shock, though it begins as one. It's more precisely a supply shock amplified by market structure. The initial disruption, real or feared, triggers the price movement. But the market's own architecture, its pricing inertia, its logistics dependencies, its insurance layers, its producer incentives, amplifies the shock and extends its duration well beyond what the underlying physical disruption might justify. Economists sometimes call this an asymmetric price transmission mechanism. The plain English version is that the plumbing of the oil market is built to transmit bad news faster and more completely than good news. Every time a conflict, a natural disaster, or a policy decision threatens supplies somewhere in the world, this mechanism activates. The Strait of Hormuz is one of the most sensitive triggers in that system. Roughly a fifth of the world's seaborne oil passes through it, and any credible threat to that flow sets the mechanism in motion. Understanding this doesn't make the price spike less painful, but it does make the pattern legible. The next time you see fuel prices climbing on geopolitical news and hear analysts saying they won't come down quickly even if the situation resolves, now you know exactly why. That's not pessimism. That's the architecture of the market, working exactly as designed. If this kind of structural explanation is useful to you, subscribe to Investors Club Global. We break down the mechanisms behind financial news so you understand not just what happened, but why it was always going to happen this way. Leave a comment below telling us which commodity market you'd like us to explain next. And share this video with someone who's wondering why prices at the pump never seem to fall as fast as they rise, because now you can explain it to them.